My guest today on the Alpha Exchange is David Puritz. He is the founder and CIO of Shaolin Capital Management, a hedge fund located in Miami and traversing the asset classes, I should say. Dave, it's great to have you back on the Alpha Exchange.
Dean, thanks for having me. I'm really looking forward to re-engaging. It's been a few years.
Absolutely. So first time you were on was March of 2021. And boy, a lot has happened since then. So let me just set the stage because I just looked. IG and high yield credit spreads are essentially exactly where they were at that time. The VIX is a little lower, but 1-year S&P vol is exactly where it was. The big difference is that 5-year rates were 75, 80 basis points back then. They're now close to 4%. We all know about the policy rate, much, much higher than it was. It was at 0. So much has changed. We've experienced so much on the risk front. And I'll just start with one of the things you said that was just really spot on around the converts market, of which you have a specialty. You said, avoid low coupon, long duration converts. And it turned out to be really a very strong recommendation as the Fed, got really well behind on the tightening front. And we saw, kind of a joint stock bond drawdown of epic proportions in 2022. So that's one of the things we'll kind of dive into. Just to refresh the listeners, give us a sense as to what the MO of your platform is, what you're trying to achieve on behalf of your client base, your investors.
Sure. We're focused on high quality, non-correlated returns. Idiosyncratic credit equity expressions, cross capital structure. Our goal is not to replace any betas in your portfolio, but to control for, again, non-correlated high quality return streams and convexity in both directions, meaning we make money when the market's up, we make money when the market's down, but we're not looking to substitute in for your S&P exposure. You can get it 25 basis points. Truly idiosyncratic, diversifying credit opportunity fund.
And diversification is something that can be very elusive. It used to be a lot easier. I was just looking this morning and I ran the rolling 6-month realized correlation of daily returns between the S&P and the TLT. Just use that as some version of a bond proxy. And I ran that from 2008 to now. From 2008 to the end of 2020, that daily correlation averaged minus 45%. Since 2020, or the start of 2021, it's averaged positive 4%. So that kind of free lunch of, the long end of the yield curve being such a defensive risk-off asset while also providing a little bit of coupon, going up, reasonably consistently along the way, is just feels like a thing of the past. It's certainly left us in 2022. It hasn't really returned. And so maybe we'll start there with just the idea of diversification in a world where a lot of things feel crowded. How do you approach finding those things that are trying to diversify a portfolio?
I think for large cap and large cap equities or U.S. government bond markets, I think we're in something like a 38% drawdown on the 20-year U.S. government bonds since 2020. Doing that around large cap indices and even around factors in equities, that's not really our thing. I think we're kind of fortunate to be placed in an asset class or collection of asset classes that are fundamentally uncrowded and inefficient. And that's due to the type of issuers that are involved, some of the complexity of the instruments that are involved, but also the fact that many of the participants in our markets, a convertible bond as an example, you can look at that as an equity income instrument. You can look at it as a credit instrument. And it's different things at different parts of the spectrum. It's a collection of risk factors that looks different to different people at different moments in time. As a great example, in a convert, you can have 1,000 over. So a credit spread that's 1,000 over. That's a 2% coupon. No yield person is going to look at that trading around par. 2's up 20, maybe a 20% conversion premium. No yield person is going to look at that. But we have the instruments and sort of the ability to extrapolate out the implied credit risk that you're taking there and forward return that you're taking there. So there's just barriers to entry that consistently create this inefficiency in a space that really since '08 sort of left for dead for a period of time. And that's what attracted me back to the space when we decided to launch the fund.
Let's talk a little bit about the state of the state in converts in 2025. It's been a pretty big year on the issuance front. A lot of participation from Bitcoin-oriented companies. Of course, MSTR led the pack in prior years, but this year you have giant deals from Alibaba. You've got, I think, JD. I don't know if that was this year, but they're also a big issuer. And I just was looking, it looks like the ICE Convert Bond Index is up about 10% or so this year, which is going to be, close to on par with the S&P, but certainly with a significantly smaller drawdown, less daily volatility. Give us kind of your sense as to where things are. What stands out to you right now in Convert?
It's interesting that we're doing this together from 21 and then now. It's kind of come full circle to the extent that at that moment in time, we had companies issuing 0 to 1% convertibles. They are again issuing 0% convertibles. The difference being that short rates are 4.5%. They're not zero, and that should give you an idea of the implied valuations that are coming through the convert market. It remains the only bond market in the world where you can issue paper at interest rates below short rates, right? Like it's the only way that you can do that. And we've had corporates take advantage of incredibly tight credit spreads, as you mentioned, much higher back end volatilities that have yet to really deflate from the 22-23 period. Crypto being a great example. MicroStrategy harvesting 60, 70 vol via the convert market and issuing 0% coupons. I don't think that's a sustainable long-term valuation trend. Like, again, it reminds me of what you said at the beginning of the show, which is if a sequence of cash flows have to sort of underline, the duration of an asset, whether it's equities or credit, we're at a point where we're really pushing the envelope. And whether it's credit risk or volatility, there are just so many ways to lose. And of course, the funding is really challenging, right? A 0% coupon convertible, and you're funding it net of, 100 bips through the middle, long, short. So any imbalance there is at 5%, let's call it on the long side. So again, valuations are extremely rich. And I would sort of recommend the same thing that we talked about back in 21, which is you got to control for duration, because I think there's plenty of room in a portfolio for interesting vol-oriented names if it's 1 or 2 year paper where you can actually capture moves in the equity. But as you go 4 or 5 years out, 6 years out, 7 years, you can't tighten the credit spread past 100 or 150. And if it's 50 or 60 vol, the sustainability of that is questionable. Like there are a lot of ways to lose and very few ways to win on a correlated basis. At the end of the day, converts are vol credit correlation in many ways. And again, credit can only tighten so far. And we're coming out of a period of relatively elevated vol. Single name spaces like crypto. I mean, I was looking at Coinbase convertibles earlier today. 2030 paper, 0% coupon. Just for fun, I want to throw 150 into the model. They're like 48 vol. Recent realized has been 40. It's very hard.
150 credit spread?
150 credit spread to 2030. It's really hard to make the case that there's no margin for error. As in, if vol comes in and short-dated realized vol is 40, your implied credit spread is negative. It's tighter than zero. So there's a lot of risk not in our book, but in our marketplace. You can express it as vol, you can express it as credit, but risk premiums are way too high in our world. There's too many points of premium reflecting, I guess, the opposite, very low risk premiums, tight credits and high vols.
It's such an interesting pricing environment. And as I look through some of the issuers, you mentioned Coinbase, Tesla, GME did one. And I look at some of the commonality, and of course, we got to include MSTR in there. One of the commonalities is not just the level of vol. So a lot of these are pretty high implied vol names, but the skews are substantially upward sloping in many cases, right? The bid to the call skew is really a definitive kind of pricing metric for a lot of the stocks and converts that folks seem to have interest in. So in the S&P, of course, we know that if the 50 delta vol on the S&P is 20, maybe the 25 delta call is 16. It's a downward sloping skew. And again, names like Tesla, Coinbase, these stocks have sufficiently seen upshocks. And perhaps it's a sky is the limit philosophy from the investor base. Maybe a lot of that's retail. There's a big bid to that far out of the money call. And so it seems like that makes the pricing of the convert almost even trickier for someone like yourself.
Yeah, no, it definitely does. I think it reflects some of the kind of meme-like nature of some of these issuers and their ability to harvest that exact volatility skew. Good examples, again, going back to 2021, that might have been ex-Chamath de-SPAC companies that were in space tourism, or, Lucid was trading at 40 and they have convertibles and actually an interesting bond. All those things kind of contribute to a company's ability to harvest really attractive implied inputs into a convert. And so having a non-traditional vol skew, that sort of gives you a sort of sense that you can have localized high volatility moves over a short period of time, or at least the option market is reflecting that, gaps effectively. At the same time, it certainly helps bankers and corporates capture their embedded volatility. Right? If you're not sloping downward, but in many cases sloping upward, you talked about term structure in terms of spot and out of the money. We also are seeing similar elements as realized vol has come in, where term structure for some of these names is higher on the leaps than it is on the 1 month or 2 month bond as well, or options as well. So that helps a corporate price vol arguably higher than they should. And again, as an investor who's on the other side of that, you have to be really, really wary of what your risk factor is there. And Coinbase being a great example. I love the credit. It's in the right regulatory environment, has the right president for now. Everything's kind of come full circle, and I think they're kind of best in breed for what they do. It's not a 55, 60 vol name, like it's just not. Or if it is, again, it's probably because something went wrong, like a custodial problem, something like that. So I feel like some of those post sort of meme or post crypto vol type names, the MSTRs of the world, the marathons, the core scientifics, they've had moments where they've been able to capture incredibly high realized. And to this point, Dean, I mentioned this earlier, we had 0% coupons in a zero interest rate environment in 2021. We have 0% coupons in a 4.5% environment now. Part of that is because the convert market has stopped using a market convention of capping volatility. When I used to do this, people would cap, as a younger person, we would trade together at Bank of America. You would always cap vol at 40. Even if it realized 70, 80, 90, and it was a solar name, you'd cap it. And, the argument being it's 5-year Vega, nobody knows, there needs to be some safety to that. It's obviously correlated with credit on the way down. So you got to keep these risk premiums at a healthy level. That went out the window.
Why is that?
I think the long and the short of it is flows. We did have sustained elements of of higher vol for a handful of names that cannot be denied. But I think it's, and this is another factor we should talk about, when there's too much liquidity in the world, there's a need to put money to work. And if you can say, hey, that's an inefficiency in the model, I actually believe that if I went to a derivatives desk and asked them for a 5-year two-way on an option, that it wouldn't be capped at 40. It might be 3 vols lower than the 2-year leap. And maybe that should be 62 or 60. And I'm not saying that's wrong, by the way. I'm just saying there's more risk. Nobody would use vol over 40 for generations. Then it was 50 for solar and names like that. And now that's completely out the window. And it's sort of like, where are the listeds, the 2-year listeds?
Yeah, I think that's one of the things I've observed as well. If you look at a name like Tesla a couple years ago, it wasn't so much that the short dated vol was high. It was, and it should have been because the realized was high. It was the sustainability of that out 2 or 3 years. So a very high and flat vol term structure is not something you come across that often, right? When realized vol pops, the front end comes up and you get an inversion. And some of these names, NVIDIA was a similar situation a couple of years ago where, even 2 year vol was in the 50s. And it just, for a 2 trillion back then dollar market cap company, it seemed extremely high and risky to own. And so it's an interesting point you make that I think what you're saying is the market clearing price to hold that paper is just not you. It's not someone who looks at the metrics of vol and credit as you do. It might be more of a fundamental tracking sort of indexation account. Is that the way to say it?
Yeah, I mean, again, there are elements of non-valuation sensitive buyers like equity indexers, right, that come into our tape, and there's a convertible long only index, and if it makes the index, they have to buy it. It doesn't matter what price it is. There's like blue chips, like Palo Alto Networks does a convertible. Like they can almost bring any price they want to because there'll be enough long only interest in that name. Of course, not any price, but their pricing will be extremely attractive as an issuer relative to a company that doesn't have the same brand name appeal. So there's that element. And then there's also crowding, as I mentioned. I mean, for convert funds that are traditionally vol oriented, that don't have a high tolerance for credit risk, and again, that may be right, that may be wrong, there's just a natural risk aversion to move away from implied wide spreads. And if you have to take your lumps in vol, maybe you could sell some listeds, et cetera, but you're never really thinking about terminal value on a vol credit basis. You're kind of going to a space that you never really worry about credit getting worse on the way down. Of course, that happens, right? Like we had Sarepta Pharmaceuticals, right, basically go through this episode earlier this year for a money good credit that traded 100 over to briefly trade down in the 70s. It's almost like it's not that bonds at 99 don't sometimes go to zero. They do. But on an aggregate basis, and I think this is a question, more around macro, is cheapness a bug or a feature in an environment like this, right? Like, are you looking to find rel-val expressions that can capture inefficiencies in the market on a long short basis? Or when you have an incredible flood of excess liquidity in the form of, government intervention and deficits, constantly printing the short end, YCC coming, all those sorts of things, should you run away from cheapness at all costs? Because it's not that, it indicates something's wrong, not an inefficiency. I think you see that in equities as well, in the form of momentum, the sort of periodic unwinds that happen around factors. It's almost like a video game, And if you're in a video game environment, do you just stay away from anything that doesn't conform to sort of the beta narrative there?
Many, many years ago, our time at B of A, both in listeds and also your time in converts. And then when you moved to Deutsche Bank, you especially had a very large hedge fund presence. You guys were a substantial part of the liquidity ecosystem and making, tight markets and helping hedge funds and other institutions move paper around. What is that like these days? Is someone, now that you're on the other side of it as a hedge fund manager, how much of the being really a part of that flow network and getting into trades, or perhaps using liquidity to get out of trades, lighten up on things, how important is that relative to years gone by?
Yeah, I mean, obviously depends on the profile, but it remains extremely important. So you and I know this fairly well, but since '08, banks haven't been able to use balance sheet to the extent that they used to. Now that may be changing again, but it's pretty much lasted from '08 until now. So one of the ways that we launched our business or built our business tactically was being a liquidity provider. As in whereas back in the day, as you mentioned, I could sit there at Deutsche Bank and be like, I'm willing to pay 22 vol for a real size, and I'm willing to pay 20 vol for a quarter of the issue. There's nobody really doing that on the sell side, even for relatively low risk profiles. Effectively, people like us become the liquidity providers in those environments. And then if you take that another step further, especially as it pertains to credit, If you're looking at something that I'd consider to be liability management, or some other sort of corporate solution around a credit that maybe has 2 years to mature, we might like the assets. The profile is very scary for other people, like Dish. Like Dish last year, where we're the largest holder of their 25 network bonds. Those bonds are trading 50. And in a situation like that, the end user of my credit is not likely to be another distressed buyer or high yield buyer. It's actually the company. It's the company that you're interfacing with on a terminal basis in that security, the issuer, effectively. So that's just another element of liquidity and understanding liquidity dynamics beyond just buyers and sellers in the traditional sense. But no, we always welcome that as a sort of differentiating feature of our business. And you kind of indicated this: relationships are really important. Handling information is really important. It's a fairly small world. Convertibles, like, people know each other. You know the behavior of a lot of other accounts, and that helps you make really good informed decisions and partner up with banks who issue new bonds, but also really good brokers who add value day to day. And so, being a good liquidity provider post '08, I remember an old hedge fund client of mine lamenting the old days of when he couldn't buy or sell 25 million bonds, like up and down a quarter. And, instead of fighting it, I think you had to embrace it and make it part of your business, because it wasn't going to be the same, or wasn't going to be the same anytime soon, put it that way. So you had to adapt and go with it.
No, I want to explore your kind of risk management process and philosophy and run with something you just alluded to, which is converts is a tight community. It's a 300 odd billion-dollar market, but there aren't all that many players of consequence. And so I'd love for you to reflect on the idea that you've got to be in some ways mindful of who's alongside you, right? So someone who's got positions on that resemble yours, their problems can become headaches for you, right? And so just take us through maybe your how you think about sizing in today's environment, perhaps bring in, a little bit of that game theory of knowing who's in what and, kind of how they think about the world as well.
Yeah, it's really important from a sourcing liquidity standpoint to kind of understand who's on the other side and why. And there are players obviously much larger than us. There are long onlys like a Fidelity in our world, and then a handful of large multi-strats, et cetera. When you see an equity move, as an example, and you pull up, one way or the other, and you can pull up a bondholders list, and it's an outright account, and you can identify a name or two on the list, 7 out of 10 times you can bet that that outright account is a buyer or seller based on the equity move alone. And that just informs the way you think about pricing, to the extent that, and again, it's not a better or worse thing. I'm not making a comparison, or saying one approach is superior, but there are a lot of people that have 50 million bonds to go, and they sell 3 a day, or try to sell them in 3 spots, 2 at a clip, as opposed to pricing 50 down to half. If you're cognizant of those flow dynamics, you're going to have to carry the weight till that person is out of a bond. They own 25% of it. So, and I think it's something that's a really great point. In my world, to get to full position sizing, you most often need to be wrong in the short term. You want to be wrong. You want to be wrong. So you want to buy a bond to start watching it. You think it's interesting. You need it lower. You want to buy it cheaper. Now, a mistake that young people, and I saw this on the sell side when I was managing a lot of people, and I see it here as well on occasion, is they go, something's cheap, but the magnitude of cheapness that makes it truly not an all-in expression, but an extremely high value expression. It's not just that something is a couple percent cheap. Like, if you're all in position sizing there, you can't be a buyer when it's 10% cheap. I think there's a subtle dynamic there on understanding that you can't be full position size on the first trade, and understanding whether or not, and again, as you mentioned, it's small world, is something a cleanup. Are there buyers alongside you? Are you buying a loan on 2 million bonds in a stress situation. You know it's going lower in those situations. That's fine. You have to be okay with that and be patient. I think credit investing in general is that way, especially if you're not momentum driven, which we're not. We're more value oriented. Your first purchase should be a bad purchase, and you use all that experience and market intelligence to hopefully capture or harness as much as you can towards the actual exit liquidity point when something can be really attractive and really interesting. And by the way, likewise, on the way up, you're probably selling something too cheap a little bit when you start doing it, right? And you sort of, you start selling as things approach to what you think of as fair, and you're going to almost always be out too early, right? Because something goes to 5% rich in your mind. I'm going at 2% rich. So you ought to be really, really comfortable being wrong every day, which is a great lesson. It's humbling in life, right? Like I'm used to telling traders as well, like, take it off your screen. Like, I know you sold it at 80. It was the right thing to do. And I know it's trading par. It was still the right thing to do. And if you had 100 chances to do it, you should do it 100 times. And it impacts psychology. I know it does for people in equity world, derivatives world. It's hard, we open this conversation talking about recency bias. One of the best ways to kind of solve for that is just to be extremely disciplined in your approach and make it more about the process and the outcome. Let the outcomes take care of themselves. Everybody says that they can do that. It's not easy to do.
You've brought a Graham and Dodd philosophy to investing here. And, it's so funny, right? Because if you think about so many of the assets that get a lot of attention, we could use Bitcoin or MSTR, we could use gold. The price is the advertisement, right? The price is the only fundamental, as I think Soros once said. And so you buy it because it went up, not because it went down. And you sell it because when it goes down, it's value flipped on its head. And that can work too.
Here's the difference. And you brought this up earlier. The longer the duration of the asset, the more that's true. The more that's true, right? Something's going to mature or you're going to convert it in a year. You can't stretch that rubber band too far unless it's bankrupt or something, right? Like there's convergence. And I think that's what's so interesting around right now. And, we could talk about that as it relates to AI or tech in general or indices. Long-term cash flows justifying valuations in equities. You can argue we're in ludicrous speed kind of land, but it doesn't really matter for long duration assets until psychology flips. Doesn't make a difference because these are 30, 40, 50-year discounting mechanisms. And I wouldn't even know how to trade that stuff. Like I like the mean reverting aspect of bonds and knowing that controlling for duration is actually meaningful in my portfolio, especially in a very tight risk premium environment.
I want to ask you just to talk a little bit about MSTR here. And you alluded to it a little bit earlier, which is, Saylor found this thing called volatility, and, it's part of his flywheel and magic money machine. And, he did wind up selling what was reasonably high implied vol to the street. I don't know how much of that got hedged or recycled back into the listed market, but it was super high. That call skew was incredibly well bid. I think it reached a crescendo of November of last year when the stock went parabolic, the vol went parabolic. Talk us through just your big picture observations as to where we stand in the universe of MSTR converts, and then also perhaps just touch on a couple of other parts of the capital structure you find interesting.
Yeah, I mean, listen, again, maybe this is again more about positioning and psychology and liquidity, but we could sit here and argue, why should any company trade at a premium to NAV when you're a treasury company? And I think a lot of that is a flywheel, as you mentioned. It's psychological. It can mean revert. It can also, if you try to short it and buy Bitcoin, you can get yourself knocked out of business. It's part of the sort of vagaries of like we've seen before around meme names and the apes and all that kind of stuff. I'm not passing judgment again on that one way or the other. I actually, and you and I have talked about it, I'm a big believer on a secular basis in fiat hedges, right? Like fiat, like personally, and to the degree I can express them in the fund directionally. So without passing judgment on the viability of premium to NAV structures, I think one thing that would reinforce really good capital allocation for treasury, we've had a bunch of de-SPACed treasury names, et cetera. The notion that when you trade at a premium to NAV, you sell stock and buy the underlying, the opposite also has to be true. And I've seen this with MicroStrategy in 22 or Marathon and other names when they were extremely distressed. I mean, I know people don't remember this, but MicroStrategy at the lows, I think the bonds were trading the 70s with 2 years to a par put. And the stock was at a severe discount to NAV. What you're supposed to do is sell Bitcoin and buy stock. That's the capital efficiency on the other side. And for Michael Saylor, and I think probably long-term right, or so far long-term right, the concept of reducing NAV to capital manage your capital structure, right? To efficiently manage your capital structure. I don't think that's something he personally would ever want to countenance. Yeah, I think he'd rather do like secured debt. But we're seeing other people in the space claim to at least actively manage on the way down premiums and discounts to NAV. I also want to note that this space is becoming interesting. It's dovetailing with another AI thread, and I think this is actually probably the more interesting area. CoreWeave, trying to acquire Core Scientific. Core Scientific, we were very heavily involved out of bankruptcy. We bought a bunch of bonds after they emerged from bankruptcy. Part of that play was that Bitcoin miners are uniquely positioned, that ecosystem is uniquely positioned to cross into the AI data center space. So not only are there, Bitcoin related enterprises like a TeraWulf, as an example, that traditionally were access to power, right? Like really good PPA contracts, effectively data centers, though geared for Bitcoin mining. All those ingredients made them really attractive as AI conversion stories, data center conversion stories. So it's a really interesting world because the pure Bitcoin treasury trades like a MicroStrategy maybe doesn't have that element. But as we saw with Core Scientific or TeraWulf, in some respects Marathon, there are a lot of ways to skin this concept of, again, access to power, access to a grid behind the grid often, or to a unique source of energy. And, they already are data centers. They're just data centers with ASICs. And how much can you refit those out to be data centers for AI and et cetera? There's a huge CapEx problem. But that thesis was sort of proven out by Core Scientific when they did the CoreWeave deal. And so the Bitcoin related space has really interestingly enmeshed itself with the AI data center story. At least elements of it have. And that's been an interesting phenomenon to kind of watch as well, with totally different credit dynamics. And, it diversifies credit, right? If part of your portfolio is repositionable as data centers, well, you're just not linearly correlated to Bitcoin anymore. There's another element, right? It's a valuation for you. So that's been incredibly interesting to see in the convert world where so many of these guys have access to capital.
And do you feel like that theme is just not sufficiently priced yet? I mean, obviously there's a lot of promise, but also, the pull forward on pricing in a lot of these circumstances feels pretty aggressive.
I think both are true. I think there's been proof of concepts on a couple of these. And then there's been a whole bunch of them where it's like, yeah, we're going to build it. We're not worried about contracts. And I mean, that's AI in a nutshell, right? Like across a bunch of names. I don't think anybody doubts that the secular kind of demand is going to be there. It's just sort of like the winners and losers and at what price, It's not like Cisco went out of business, like post 2000, it just a bunch of other guys did. It was just sort of at what price are you willing to pay in aggregate for those future cash flows? And some of these guys definitely are not going to have contracts, and maybe the demand goes down, or inevitably, you mentioned NVIDIA, how long can a company have 80% gross margins
Right.
and 80% market share? inevitably there are cycles in this stuff, right? Where other elements come into play in competition. So we'll see how it goes. I think it's been a really, on a name specific basis and maybe a sector overall basis, some part of it has been validated by the CoreWeave deal. I think it was TeraWolf and Microsoft signing a big deal. So, like, there have been data points that are extremely encouraging for this. Are there ones that are completely questionable in efficacy, or maybe they'll be late to the party and they'll never get a deal? Absolutely. 100%.
You mentioned sort of cheapness, the concept of cheapness before. And I was thinking about insofar as converts, there's a number of ways you might come at this. And I just wanted you to riff on this a little bit. So, a name could get cheap. Perhaps there's a distressed seller. The product set, the convert universe has experienced periods of real cheapness where capital was just in very scarce supply. You could think something's cheapness based on your own credit work, where you just see things differently than your counterparties. And then lastly, was just remembering understanding the docs was a big deal, right? Docs arbitrage. And so when you think about cheapness, I'd love for you just to expand on that a little bit, how you arrive at it, and where you wind up differing from the marginal price setter.
Well, I'm going to call it value, I guess, let's just call it value. So you can have fundamental value. You can have value in your beta, in the beta set. And then the third one is technical value. And technical value could be a doc arb. It could be something in a mandatory that somebody's missed. It could be a taxable, non-taxable event. There's a whole bunch of different things that fall into that. So on the first one, which can express itself as cheap vol, cheap access to a corporate action, or credit underwriting, there are a lot of idiosyncratic opportunities that pop up in a world, like I said, because you have a bunch of vol-oriented people that don't love to do credit work. You have a bunch of long onlys that are there for an equity replacement idea. They're not there on the way down. When the stock gets cut in half, they want to be out. And that's going to test that credit bond floor. And who's willing to do the work on Green Plains renewable energy and who's not. Not that many hedge funds necessarily want to do that type of credit work or have a risk tolerance for it. So I think those have always been sources of value for us. Like, that's the traditional convert suite sources of value. It kind of speaks to the inefficiencies that we talked about a little bit high level. Value in the beta, which means like the whole convert market got cheap, kind of what you said. Those are often, but not always, associated with high beta moments in markets. So 2020, 2008, 2018 even, those were high beta moments across all asset classes. And there was you didn't have to be directional. You were just getting cheap convexity between credit and vol in all directions. Risk premiums, you didn't have to pay much for a range of outcomes that, again, it's like buying really low absolute vol, but credit sensitive oriented, right? There was deleveraging. And that is the easiest environment if you're not the one that has to delever. That is the best. And I think we always maintain as a business a really healthy amount of unencumbered cash, sometimes to our detriment, because we never want to be delevered. And when other people are delevering, we are one of a handful of buyers. And that's how we generate for, relatively conservative, high sharp, modest return asset class. We can put up a 60 or 65 in 2020, right? And do it broadly diversified. So, there's those two types of sort of environments. The convert specific beta cheapness is another form of delevering. And I would associate that with 05. It's one of the times that I saw it. And I'm a little scared about it now. Hedge funds were 70, 75% of the market. And what you're seeing today in volatility coming in with really tight credit spreads, very similar. And in that period of time, the market really didn't do that much, but convert arb got absolutely annihilated. At the time, it was called Vomageddon. And it was because volatilities went from 38, 37, 38 to 20, and every convert fund was getting tapped out by their prime broker and having to sell it at 15, 17. It was literally like a delevering event that was specific to our space. I think the risk of that is a little higher than it has been in a really long time because, let's say in 2020, hedge funds were, 30% of our market. They're back to 70% of our market, and we have really tight credit spreads, right? Like we talked about at the beginning, there is no bailout for vol going down. The Coinbase example, take it to SOFR plus 100, sure. Like, could Coinbase be 35 off? Sure.
Right. Well, it's funny, you mentioned this kind of interaction between credit and vol. And just going back to our first conversation in March of 2021, I'm remembering towards the end of that year, really just thinking through the really epic divergence between the volatility that we saw in stocks. Remember, this was kind of the meme year. There was so much froth. So stocks were very, very volatile on a realized basis, even as credit spreads were extremely tight. And so if you compared, I don't know, S&P vol to HYG vol, they were, that ratio was as high as we've ever seen it. And because it was just an environment where stocks were realizing a lot, but it had nothing to do with credit spreads. It was all valuations. It was sort of more like 2001 when you and I first worked together. Talk to us a little bit more about that interaction. When you buy a convert, you're buying vol, but you're kind of selling it too, right? Through taking the credit risk. So there's a push and pull there.
Yeah, and absolutely. And again, I'd flip this back to a duration question, right? Like, I'm not good enough to handicap exactly where 5-year volatility is going to play out on a realized basis. What I can tell you is that if I'm wrong here, I'll be right there. And if I'm right here, I'll be wrong there, meaning credit and vol have an interplay. So to go out on the curve, like meaning longer duration, there has to be a reasonable amount of total, you have to have a really good pairing, a correlated pairing that allows for mistakes or allows for slippage on one side or the other, but terminal value to be realized over time. I think you're 100% right, especially in tech. And then, of course, meme names, we had prolonged periods of like 40, 50 vol with almost no credit vol. And those are great times to be involved in convertibles, obviously, because you're trading the stock every day. But the correlated side of credit widening isn't there. Now, I am always willing to go longer on the risk curve if I'm getting paid for it. But when you have a time of tight credit spreads and high elevated vol, I think you can choose a handful of places where you're willing to do that, short dated. But I don't want the beta of that in my portfolio on a 5 or 7 year basis. It goes back to kind of what we said about equities as well, and how macro kind of gets distorted. Duration is probably the most important thing that you need to think about, whether you're investing in almost any asset class, but especially at times of expensive valuations. One of the best ways to defend yourself is to control for duration and understand, like, even if you don't think it's going to happen, like, and this is a really important lesson, I think, for young risk managers in general, it's not just the probability of something occurring, it's the amount you lose if that occurs. Like, it's the magnitude of the downside, And so, like, you might have a relatively modest probability of loss, but very limited downside. It's like me sitting here and arguing with you on an IG name, whether it should be 16 vol or 17 vol. It doesn't really matter, But if you're talking about that at 50, 55 vol and it's an IG name, you can lose a lot of money. You know what I mean? So what we would call low absolute vol expressions, for example, at some level, you're not really going to lose money, or you can't lose much, So, as you risk manage, I think, and this is why duration is super important, Vega, CSO1, they're all magnified at the long end
Yes,
of the risk spectrum, right? So it has to be worth it to you.
You mentioned duration, and we've been talking about converts as an asset class and specific names they're in. But as you mentioned that the term duration, I can't help but think about just the macro environment. And you do a ton of thinking on defending the portfolio, diversifying the portfolio in light of the very strange set of macro circumstances in front of us. What do you see, just big picture, in terms of, perhaps we'll start with the back end of the yield curve as maybe either an opportunity or a threat? I'm not really sure, but let's kind of zoom out and talk a little bit about what's on your mind macro wise.
Yeah, I mean, I love thinking about macro from an intellectual standpoint, but also because it's important in my world because I think of it like tides. So, when the tide is going out, there's a lot of stuff that maybe I want to buy and I have good opportunities to do that. Tide is coming in, we have good opportunities to actually take off risk. You know what I mean? So it is important, even if you're expressing via micro corporate expressions, to have a little bit of a pulse, take a pulse of macro and have some views there. I've been thinking about this a lot, and I'll ask you like the four most dangerous words in finance.
This time is different.
It might be. And like that, I think that's the thing. We talked about recency bias and adjustments, and, sometimes learning lessons the hard way penalizes you in certain environments, right? Like you're cautious when others are completely headstrong. Yeah, this time it's different, right? So you mentioned the long end of the yield curve, and I think about this all the time, but deficits, like the total amount of debt, and obviously we're just talking U.S. government debt, but let's just talk about financialization in general. But U.S. debt specifically will equal the amount of money in circulation, definitionally, right? Because we can't default. So the growth in debt is the growth in the money supply over time with interest and all that kind of stuff. And the market has looked through to that liquidity and tried to find ways on both a real basis and a nominal basis to solve for the same problem, which is fiat devaluation, effectively monetary debasement. And there are implications for politics and polarization and wealth inequality and obviously inflation, right? I'm not sure. I think as of last Thursday, the S&P was flat in gold terms on the year. Something like that, right? So
No, I'm not sure. Gold's up 37%.
yeah, so I'd have to go back and look at those numbers, but my point is that nominal wealth and real wealth they're very different, and it may have been on an annualized basis from the year before. Somebody posted this. The thing that's a little bit weird, and we've talked about a lot, is like whether it's gold or Bitcoin or real assets or things around that dynamic. You have to, and this is not about our business per se. It's much more about macro. People are probably still overall underinvested in that conceptually. I do think that I probably am as well. I do think the flip side is that more and more of the market knows about fiat devaluation, whereas like you and I would have had this conversation in 21 and said, where's the end game? Because I don't think we can ever reel it in from what we just did in 2020. And now that people are talking about it. Now, the long end of the curve, the long end of the yield curve is a fancy way of saying I want a short currency. That's all it is. And if you want a short currency, don't short the long end of the yield curve because history tells you they will control that, meaning the government will cap it. So, Japan YCC, there are banks being forced to buy long duration US government bonds. I have no idea what the mechanism will be. But if you want a short currency, just short currency, buy some gold.
There was just a piece on the terminal today about Stephen Mirren, and the Fed's third mandate, which I always thought was financial stability, but they basically, the article is suggesting that it's effectively low or moderately low long-term rates.
Yeah, they're talking about a housing crisis and restarting that. So how creative are we going to get around these things? But I agree. That's why I wouldn't short the long end. Like the core thesis is intact, but I'm nervous about that expression point. And you did mention it. And obviously, that's that's going to be a priority. That that whatever that third mandate for the Fed. And so again, if you study history, we don't want to get too crazy here, but that all ends eventually in some form of capital controls. And you might have to turn your Bitcoin in or your IBIT in at some dollar price and your gold in at some dollar price. But going back to your GLD, at least this time it's different. The truth is we have never run deficits, and across all developed markets, currency debasement at levels like this outside of wartime never happened. So in an environment like that, I have a really tough time picking a top or picking a moment where valuations actually matter, because mean reversion requires scarcity or a shock to the supply of liquidity. Otherwise, there is no mean reversion, or doesn't have to be. It could happen, but doesn't have to be. So in an environment like this, I'd be looking at something, if you're asking like what could mess it up, I think the market really sold off in April, not as much about tariffs, but to me, it was about Doge and potentially cutting spending and, again, stemming the tide of liquidity. And once that was backed off of, it was sort of back off to the races. Or it was the same the day after Silicon Valley Bank. Hey, we have a banking crisis. Wait, we're going to bail. We're going to make sure the system's fine. Okay, you should go buy everything. It would have to be some shock to liquidity. And I think that would be probably technical in nature, like a dollar rip or some VAR accident somewhere. But outside of that, I mean, I do think this time it's different to the extent that, if you were Greece, you'd be forced to do 5 to 7 years of austerity. And you come out the other side much better off on a 20, 30, 40-year basis. For the US, who's doing that? Like, who's going to...
just to get up to a primary balance of, your budget deficit extracted from interest rates, the interest rate haul, that's 3%. In other words, we're paying 3% of GDP on interest per year. And I think the average coupon is 3.2%. Now, of course, the back end came in quite a bit. So who knows? Maybe that rolls into something that's not, a ton higher. But I wanted to zero in on this with respect to the dollar. I had Ken Rogoff, who actually wrote a book, This Time is Different, on the podcast a couple weeks ago. And his new book, which I highly recommend, it's called Our Dollar, Your Problem, which is a famous saying from the then Treasury Secretary John Connolly in 1971 in and around the Bretton Woods unwind. And Ken makes the point that dominance is just not a thing we can expect forever. Might continue, but he makes a really interesting point, Dave, which is one of the features of the dollar as a reserve currency has been its defensive characteristic. In other words, if you look at COVID, if you look at the GFC, big risk offs are dollar rallying episodes. And if you look at the tariff tantrum in early April, that correlation got flipped upside down. So I think that's super interesting and cautionary. And then I just wanted you to reflect on Bitcoin, because I know you're in this both on a personal level, the fun level. When I think about Bitcoin and I get more comfortable with it, it's not about, the $115,000 price. It's basically the question of, is this thing going to outperform the dollar? That's really what it is. It's an outperformance option, right? And so how do you think about Bitcoin as a diversifier, as a kind of anti-fiat product? Talk to us about that.
Yeah, I mean, first I'd have a question, which is sort of like, why does it make you, like, what are you cautionary about in terms of like...
I'll tell you why I get the things that make me cautious, candidly, are Michael Saylor, the best unpaid PR executive on the planet. No one is more compelling at creating FOMO. And I worry that he's a part of the returns, that his buying engine is a part of the returns that feeds back into the hype cycle. So that would be one aspect of it. And then look, you do get anchored on price, right? Oh, it traded at 30,000 a couple years ago. Why am I buying it at 115?
Yeah, I think you're kind of like, there's circularity here that maybe we could explore. Like, if we're concerned, as Ken Rogoff said, that, the dollar all of a sudden was a risk-on asset, on the way down, right? And that kind of relationship flipped. That's kind of like me telling you earlier that everybody knows that it's about currency devaluation now and excess liquidity. Kind of like when we talked about earlier that bonds used to be a defensive asset when stocks go down, and then they were heavily correlated, and you have this risk parity concept. So there's changes in sort of narratives and explanations for what is effectively just liquidity and excess liquidity, and how people are trained in recency bias to act and react all of a sudden flips on a switch when everybody all of a sudden knows that we're just printing too many dollars and they have to go somewhere. So to that point, on something like Bitcoin, which is a declining vol asset, but has been volatile in the past and will almost certainly be volatile again, the concept is basically, at least to me, a digital form of scarcity that scarcity is encoded in its DNA and is not mutable, changeable, assailable in any way, shape, or form. That's the value proposition, effectively. And that you can bring it with you. Like if you were started a really successful business in a geopolitically or a tough part of the world, let's say, would you trust your bank in that tough part of the world? Or would you rather have 20 Bitcoin? Because then you can fly to Paris and like use them. There's a whole value proposition there for non-developed market, for emerging markets, for privacy, for transportability versus gold, et cetera. The biggest risk, I think, we talked about capital controls, would be some change, would be an existential threat to code, actually, would be either that the supply somehow became not limited, right? Or, this is thinking way too far in advance, again, other than capital controls, something like quantum computing could hack it.
I was reading about something like that. Yeah.
Right. So like if that happens, we're screwed. You know what I mean? Like you're messed up. But I look at Peter Schiff's stuff all the time as well. I love gold. We have that too. I don't think you have to have one or the other. I think you should have a little bit of both, because the core trade is we're making too many dollars. And this has happened before in the UK. This has happened before in the Netherlands. If you read Dalio's book, for example, there's sort of like there's a pattern here, around debt.
Yeah. Niall Ferguson, the historian's got a good ratio. He humbly names it the Ferguson ratio, which is the ratio of what you spend on defense to what you spend on interest. And we just crossed below. And he points to the Dutch Empire, the UK Empire, these great empires that they don't last forever. And that Ferguson ratio of spending less on defense than you do on interest it's kind of a 4 or 5 for 5 type of thing.
Well, you know what I find really interesting, and I think Dalio does a good job of this in his book. We have this monetary phenomenon of too much debt, and therefore we're going to have too much excess liquidity, and we're racing to keep up on the nominal side. And there's actually real assets that can generate real returns, That's almost always linked up with social and political strife. And it's happened throughout history. And I guess in some ways it's sort of simple. I mean, we're at a moment where, I don't know exactly what the percentages are, but if assets have to keep up with money supply and we're in a period of relatively modest to high inflation, asset owners are the ones who can do it, who can survive that. And I feel like this sort of the wealth inequality problem that gets exacerbated by, it's kind of like the to be cruel is to be kind kind of thing. Like where, let's continue to grow the budget and make sure that, provide better healthcare for everybody, et cetera. Again, I'm not debating that we should provide better healthcare. I'm just saying in an environment like that is deficit driven, you exacerbate wealth inequality. Like 30-year-olds can't keep up and they vote for Mamdani or they go away the other way. And that's not surprising to me. It also has happened in almost every instance of a reserve currency sort of losing its status. Internal conflict and or external conflict comes with it. So I think as much as it sounds like we're kind of nerding out here talking about finance stuff, there are real world impacts, and you can feel them all around you. Just a more polarized environment, and money is at the source of that. You know, monetary policy is actually really heavily linked to that.
Yeah, and then just like last little topic or question, around, of course, the Fed meets tomorrow. We're taping this on a Tuesday before the first day of the Fed meeting. A lot of questions around Fed independence. I think it's really notable that Mirren is actually still at the CEA. He's on leave, unpaid leave. And so you have a guy that works for Trump that's sitting on the board of the Fed. Fed independence is a not all-time thing. It certainly wasn't the case in the 50s. The board was highly politicized in the 70s. How do you think through that with regard to market prices? Is it something that could spill over, in your opinion?
Only just as an episodic, it would be like an excuse for overpositioning more than anything else. Um, I think we're in a world that kind of blatantly has no rules anymore. And like that kind of spills into investment behavior, political behavior, you name it. And it ties into the question you had earlier, like, why is the Fed cutting rates anyway? Because they can and they have to. That's the simplest answer. Like they have deficits they need to fund. They control the cost of those deficits. I don't know. If I was a borrower, I'd lower my interest rate too. Right. Like, so of course they're going to cut rates. Like, it's just like getting there. So, I mean, it bothers me. But again, I probably put it in the context of everything else, which is it feels like we've broken rules around valuation. We've broken rules around deficits. That spills into behavior, political kind of taboos, things you're supposed to talk about, can't talk about, things that you never thought you'd see happen. And underlying a lot of that, I really think, is that like whether they can articulate it or not, people know that a dollar is not a dollar. So it's like feels to me like there are just a lot of like sort of there are a lot of things that this time it's different, like that we weren't trained for here. That you and I we were not trained for with sort of classical finance backgrounds and thinking about valuation and mean reversion. And I think it's, the video gamification of finance when there's just so much excess liquidity. And that's why I say it's episodic. Like, do we sell off because people are too long? And then they say it's because of the Fed independence thing? Sure, maybe. But at the end of the day, it's really hard to think about value and valuation and wealth when you're creating so much excess liquidity via debt.
Well, we'll leave it there, Dave. It's been amazing to have you back on. I love the conversation.
Yeah,
Give
fun.
give the listeners a lot to think about at a very complicated time in the world, certainly in global markets as well.
Likewise, I appreciate the time. Always a pleasure, Dean. And let me know. Well, I'm happy to hop on again and always enjoy the show.
Awesome.